have Rahul Veera. He's the fund manager of equity at Nippon India, joining us on the show. Rahul, good afternoon and thanks for joining in. The strategy here on in these Indian markets, how are you approaching them now at this point in time?
Right. Hi, good afternoon. Our idea is at this point of time, right, be very stock specific, focus on companies which are having strong earnings visibility and convert on valuations. And our last 3 years has been a little bit too momentum-less market. Everything was working. We believe going forward, it will be very selective market. In terms of the stock selection, it will be very, very critical in terms of your convictions, in terms of your earning visibility. Have that comfort, stay with the portfolio for next 3 to 5 years. We believe that still there is a lot of money to be made in the medium term. Near term, there could be volatility from a global perspective as well.
All right. Well, in that case, areas that you like, Rahul, areas that look interesting to you, where there is quality and perhaps a valuation comfort?
Yeah, so some of the themes like power, right? We believe that the power transition theme over the next 3 to 5 years in India specifically is going to play out very well. Now, next 2 to 3 years, we know that 14 to 15 gigawatt of capacity is getting added in India at 237 gigawatt of peak power demand. We are seeing some shortages that will happen in India from next 2 to 3 years that will continue. A lot of capex plans in the transmission side as well. Almost 9 lakh crore, 9 trillion was the layout given by the government for the NEP2 plants. We believe a lot of opportunities in this particular segment will play out. There is still decent earnings comfort as well as the valuation comfort in some of the names in this segment. The other segment that we like is the pharma. We believe the earnings consistency, whether it's not just the CDMO, but even the branded generics on the domestic side will do relatively well. On the global side, the larger names in the pharma will see some volatility as one of the large key molecules is going off patent, and that could be lead to some kind of a P&L pressures for some of the names who have not been able to substitute it with the equally good opportunities.
Rahul, good afternoon. Neeraj here. Great talking to you. I believe it's the first time that we have you on NDTV Profit, so thank you for your time. And correct me if I'm choosing one fund as a depiction of what you might be thinking about the whole portfolio, but when I look at the Nippon India Growth Fund, for example, I see that there is a fair degree of bias towards the mid-cap end of the market. Your giant caps and large caps are maybe about 35–38% and not really dramatically higher number as some of the other fund managers have been telling us. I found that interesting. Why is that the case? Everybody seems to be more constructive in large caps and find safety there. You're not quite doing that.
Yeah, hi Neeraj. So now just to talk from the Nippon AFI side of it, right? So we believe that mid caps and small caps from a 10-year perspective, right? If you see the returns that have been generated, the kind of alpha that small caps and mid caps have made, and given at this point of time, the valuations, we still continue to believe mid caps and small caps will do well in the medium term. Near term volatility will be there. Now, for example, if I take the case of Nifty Small Cap 100 index itself, right? It's at 18 PE today on a FY27 basis, almost closer to where Nifty is today. So a lot of people have these questions that usually it trades at a discount. But if you see the earnings profile for between the large caps and the small cap and the betas or the PEG ratios, hence we believe that small cap will continue to do better in the medium term.
Interesting. Okay. So, but typically the way a rising tide would carry all boats higher, a tide which is going down might even drag the good boats lower, right? So is that a risk that you foresee in the very short term? Or do you believe the 20% correction that we've seen, circa 20% that we've seen, kind of bakes in the negatives?
See, the intensity of correction that has happened in the past 6 months, right, has baked in a lot of valuation drop that was there in the system. It has largely taken care of that. At this point of time, somewhere the comfort is coming on in terms of valuations. Broader market may not do well. If you see NSE 500, right, the profitability growth between the top 100 and the bottom 400, still bottom 400 profitability pool is growing at a faster rate, although the pool is smaller. So NSE 500 profitability of 14 lakh crore approximately, right, that has been growing in the high single digit. Now, if you remove the cyclicals, OMCs or even the global cyclical like metals, then the earnings growth is in the 10 to 14% kind of range. So there are opportunities. The profit pools are increasing in the mid cap and small caps space as well. So your PEs are deflating. So near term pain in the volatility, it will be there. But medium term, again, these things, as you rightly said, the tide will be back. In 3 to 5 years, we'll see the decent earnings growth happening, and probably the stocks eventually will reflect that.
All right. And Rahul, I want your opinion on what's happening globally. I want your opinion on dollar index, the way things are panning out. Of course, you know, the way changes are happening with respect to US policies and the kind of implications it may have for fund flows in India. How are you reading the situation?
So on a global scenario, if you see, usually US and India, in terms of ROE profile of the companies, right, at the index level, has always been on the higher end, including the PEs for both these countries. Now, there is some kind of a asset reallocation happening. In the near term, yes, 6 months basis, we see some kind of a continuity in terms of outflows will happen. But again, in the mid-cap, small-cap space, you will see that largely it's the HNI and retail money that is more critical here. We believe that that is more or less stabilized at this point of time.
All right. And in the way you are going about constructing your own portfolios at the moment, say, for example, you have about 30 stocks in a portfolio. Are you witnessing, or does it land up at this point in time that you have 25 instead of 30 or 35 instead of 30?
No, so we are at closer to 30. What we have promised to the investors, we are in line with that. But in terms of the cash in our recent most portfolio, we have almost 35% cash in the portfolio, which has helped right through this volatility. Now, in terms of the conviction, like we are building positions in some of these very niche names, again, pure bottom-up stock selection strategy across pharma, across power, across of some of the selective consumption names we are doing.
Rahul, this, so again, just trying to understand this strategy of spreading out, and of course your AUM is very large, but the strategy of spreading this whole AUM out across, I think in one of the schemes it's maybe 90 odd stocks, maybe some of the others it might be lower, but are you consciously doing that in order to mitigate the risk of you know, some accidents happening, and would you veer towards a more concentrated strategy once the market stabilizes, or not quite that?
Right. So see, in our alternate space, right, in Nippon alternate, so we consistently are doing 25 to 30 stocks only in each of the portfolios. So they are slightly higher beta, but we believe, given the strategy and the conviction call that we are taking in the portfolios, we believe that this will help us in the long run. So the kind of alpha generation possibility these concentrated strategies have, that can help the investors to generate that incremental alpha in these alternate strategies.
Now the other interesting thing is what you started off the conversation with in terms of what do you like, and there seems to be almost a consensus for healthcare, but within healthcare, after Donald Trump's comments and the fact that maybe Revlimid revenues for a lot of companies might come off, people have taken the sheen of pure play pharmaceuticals which are US exposed and focusing more on CDMO, on hospitals, on diagnostics, and that variety. Now, I'd love to know, how are you looking at the healthcare bucket?
Sure. So if you see Revlimid, right, it was a very large opportunity, almost $8 billion in US itself and global $12 billion. Now, when such a large molecule with very strong gross margins and EBITDA margins in the portfolio for a lot of these Indian companies as well who are supplying, if suddenly that goes off, it's very difficult to replace with any other molecules. So the kind of volatility in the P&L, right, even if you're doing a SOTP for all these pharma companies, large cap names, it'll be very challenging for a lot of these names to do scenario analysis. So we believe some of the money will go to where more certainty in terms of earnings profile will be there. So CDMO, again, branded generics on the domestic side, and probably hospitals. So largely these three sectors buckets will people start realigning themselves now.
Okay. Okay. The other aspect, Rahul, that is around tech. Now, of course, what the commentary from global majors might be is difficult to say, but Walmart sounded off the bugle of caution overnight. And in the last 4 or 5 days, we've seen two distinct types of notes from the sell side, right? One on LTTS today, wherein they have clearly focused, one of the brokerages has clearly focused on the valuation comfort. And there was one 3 or 4 days ago on Persistent, wherein they are saying it's a quality franchise, having corrected, we want to buy it because it will continue to deliver growth, so even if it's expensive. When you are trying to pick up businesses at the mid-cap tech name, if you will, you are preferring growth, or are you preferring the valuation comfort?
Right. For us, it's largely going to be a blend of both, right? Some of the names in terms of the sustainability of growth, not the near-term growth, but the sustainability of growth. The visibility is very minimal. So what you are paying like 40, 50 P for some of the names becomes challenging for us. So what we do is we go a little bit down the curve in terms of valuations, but reasonable growth at reasonable prices that we are looking for.
Right. Rahul, I also have a question on the auto sector, not just in India, but globally, because we've had indications from Mercedes where they've said that they're expecting lower operating gains. It does seem like, I was surprised to know that Mercedes is in fact offering discounts. On the other hand, you also have the potential entry of Tesla in Indian markets, which is why we could see weakness in the EV space in the Indian markets to a certain extent. My question is, how are you going about Indian auto OEM guys specifically?
Right. So yesterday in the Siam conclave, right, the industry conclave,
Yeah.
what was some of the industry experts mentioned that the kind of growth that they'll see across CV, PV, including the two-wheelers. Two-wheelers continues to be on a low base where they are expecting like high teens growth. Also on the CV and PV, it's going to be mid-single digit that they are looking forward to. But if you see the kind of commentary they made and the delivery that has happened by the industry over the past 6 years, largely we have underperformed what the CM has guided. So from here on, right, we've already crossed 2018 volumes for two-wheelers as well as four-wheelers. So incremental growth on this kind of a base is going to be challenging. So all of us will have to work with like mid-single digit PVCV volumes and at best high single digit in two-wheelers as well. So from those numbers, you'll have to take a valuation call from there on.